Good morning. I promised we'd start on time, and let's see what the real time is. Oh, I'm 2 minutes late by this. So, okay, thank you for being here today. One crazy week. Ray has something to say. Okay, notes from last week. If you need them, check with our lovely administrator assistant. Let's see, a couple things. One, it seems like this class has gone really fast for me. Has it for you? We're week 5 and one more, and we're out of here. Okay, and thank you for being faithful up and down. Missing one class. I was supposed to start a new class for staff on Thursday. Guess what? On recording. Because, but anyway, glad to be here today. Couple things I need to say just as we ramp up and into wise investing and pursuing optimal returns. This class used to be retirement planning. And so I talk about, as you'll see, a few statistics, and then I talked about, doing the right things. And somebody said a few classes ago, why don't you do something on investing? That's what we need to know. So this is really could be called Investing 101. Now, I know if we're excuse me, in a group of 25, 30 people, there's going to be the whole range about investing. Some of you have invested and you're very familiar. Others may go, what is he talking about? So I'm trying to do the impossible of finding a middle ground that'll all give us a foundation. One, as I said in the introduction to myself at the first class, what I teach in this class is not just theory or theology. It's actually what Ray, my wife, and I have practiced over the years. And this is true about today, too. We've been invested in good returns to plan for retiring with dignity, which is where we are right now. And we are very thankful. By God's grace, that's where we are. So we'll be talking about real things. Now, I'm hoping to have maybe at the end, but it will sure stay a little after 12 if we need to for any questions, because we're dealing with a mountain of information in a short period of time and some technical terms and so forth. So I don't want to say, ask me in the middle of the presentation. I'd like to do that if we had an hour and a half. But if you have questions, we're going to try to handle them at the end or stay afterwards, number 1 or 2. And further than that, if you want to say, hey, could we sit down and talk about that? I kind of got it, but I didn't get it along the way. So we'll make that offer, inside this class or outside of this class to help us with this topic of Investing 101, pursuing optimal returns, wise investing. Everybody got that? Kind of on track? Okay, we'll pray and we're going to run. Father in heaven, thank you again for these people and all of the varieties of meeting, not meeting, and so forth. Just hung in here in week 5, and God, we're thankful for the opportunity to talk about some things, and we're also thankful for the opportunity to ground it in your word is where we will start, as we have with the other principles that we've talked about the last 5 weeks. So give us wisdom. Let us take away the things that we need to apply to our own hearts and lives and practices so that we can hear one day, well done, good and faithful servant, enter into the joy of the kingdom. This would be my prayer for each one of us who are here today and ones who may be listening online. In Christ's name, amen. Okay, on the topic of investing, we did not have to go very far to find a biblical rootage for this concept. And I want to give you some selected verses out of Matthew 25, I think, and you will see that God understands what we'll be talking about today of investing for a wise return. It's the parable of the bags of gold, or the minas, maybe called talents in some translations, but it's an owner giving a bunch of money to some people and said, do well with it. Okay, everybody got that? Pretty straightforward. Again, it'll be like a man going on a journey, so he's going to be gone for a while, called his servants, entrusted his wealth to them. Who owns all the wealth in the world? God owns it all, everything on heaven and earth. So whatever we have is entrusted to us just like this man. Now, the next verse we jump to is 2 investors doubled their funds. His master replied, well done, good and faithful servant. You've been faithful with a few things. I will put you in charge of many things. Come and share your master's happiness. We could spend 10 minutes unpacking that. What is the master's happiness? But we get the point. Some people went invested the master's wealth, it says. So we're not talking about banana peels. We're talking about, money. That's what he gave them. And he said, go and invest it well. And I'm gonna look and see how he did. 2 doubled, 1 buried his funds, no gain. And look at the harsh words. His master replied, "You wicked, lazy servant. So you knew that I harvest," because he's already given an excuse. "I knew you were a hard man, that. So you knew that I harvest where I've not sown and gathered where I've not scattered seed. Well, then you should have put my money on deposit with the bankers so that when I return, I would at least have received it back with interest." Okay, pretty straightforward. What we are given, put it where it's going to get a return because the master is expecting return. So that's the context of what we're going to talk about and move into this field of investing in a way that we get a good return. And we'll talk about purposes for it, I hope, along the way. But we're going to talk about some of the techniques, the pieces of it, to be of help to you, hopefully, wherever you are in this investing journey. Here are the challenges for today. 1, 78% of Americans live paycheck to paycheck. You go, really? I've had numerous people here at Fellowship talk about living that very way in their 60s and they're living paycheck. You go, I didn't know. Why? No, that is common. That is common. We've talked about materialism and, the seduction of advertising and so forth. 58% of American workers have less than $1,000 of savings for emergencies, future purchases, etc. And we did a slide on debt. Do an emergency fund because most people get into debt because they have no backup. When the tires go out, when the refrigerator quits, when you're off work for 2 weeks, beyond your sick time. Okay, that's why no savings. It's criminal almost that you work for 40 years and don't have $1,000 in case something emergency comes along. So emergencies. 69% of American workers save less than 11% of earnings for all savings, including retirement savings. We looked at, remember that jagged chart, of the savings and recessions and so forth? We are not a saving culture, not a saving economy. 11% is not enough to retire with dignity. Just straightforward conclusion. Don't have much time to talk about. What can be done? Number 1, an emergency fund, and that would be $1,000. That's a backup plan for those little things that are unexpected. Then number 2, short-term savings for 3 to 5 years. That's to buy your next car without going into debt. That is to replace the refrigerator or, remodel your house or whatever it is, whatever you want to save for, round the world vacation, whatever it is. But you get into the short term, and then long-term savings investments are over 5 years. Now, the reason we break it down that way is because there's different investing principles that need to be done for both your emergency fund and your short-term savings, and a different way going about it in long-term savings and investments. Okay, so we're talking about being wise to get a good return. We're going right back to the parable of Jesus. You must have an overall savings plan to reach your goals. I listened to a short video with a guy that founded a Christian financial planning thing that's gone viral, NCF. He founded NCF as well, Ron Blue Associates. David, you know that. And he was saying, somebody came up to me and said, "Hey, you're a financial guy, aren't you?" And he goes, "Yeah." And he said, "Well, give me some financial advice." And here's what he said. Get out of debt, live below your means, and do both regularly for your life. He said, it's that simple in a way, but we get caught in, one or more of those. You got to have a plan for each one of those. Now, here are the investing principles. For short-term savings, the rate is not significant. You need it when you need it. You need access, and you need it not to disappear. And I think I told you about last week about a lady called a finance program, said, "I'm just getting ready to retire. I have $5,000 in savings. How should I invest it?" Well, there's not time and there's not enough to really make a difference in your retirement. That was her emergency fund. It should have been. So short term, don't worry about you're getting 0.05. It's not a big deal. Long-term investments, it is a big deal. Rate is critical to success. And I showed you I was on that savings chart where Einstein said that compounding is a more significant fact than E equals MC squared. In other words, the issue of compounding. Compounding means I put something in, I let it grow, and the growth I plow back in, plow back in, plow back in, and I gave you a chart where, $90-some thousand from just putting away, a couple $100, a month, et cetera. It's compounding. How do I do that? Consistent investing. So it is saying to your employer, maybe, take $200 out of my check every 2 weeks and put it in. And we'll talk about where to put it in a moment. Consistent investing through the highs and lows of investing is called dollar cost averaging. Because if you just invest the same, you don't go away. The market is up this week, I don't want to put as much in. Next week it's down, I'll put more. Actually, you'll come out better in the long term if you do the same every interval, whatever it is, every week, every month, every pay period, whatever it is. You just do it. And you don't think about it. You don't think about having to spend it because it's already an automatic deduct along the way. Dollar cost averaging. You're looking for good returns. We'll talk about that in a moment. And we're looking for over a period of time that you don't touch it. Okay? Now, there is a conversation out there that says, oh, you can always borrow from your retirement savings because you're borrowing from yourself. Have you ever heard that? Do not do that. That is costly, costly, costly. You just took the money out of the compounding stream. Okay, so it's not only what you borrow, but you just pre-borrowed the earnings on it. And compounding does not work unless you leave it alone over a period of time. Give you an example. A 20-year-old guy deposits $200 a month for 50 years. So he's doing it consistently, dollar cost averaging, with an average return of 7%, which is not hard to find. And I will talk about that in a little because it sounds like it today. And it may not be easy, but it's not totally hard to find. 50 years, return of 7%. He has put in $120,000. The value at the end of that period of time is $1.1 million from compounding. He only put in $120,000, but he got let it go to work, let it go to work, let it go to work, let it go to work. His total gain was $980,000 just because of his faithfulness. Now, think about the parable. Okay, the guy says, "Here's wealth, invest it well. I'm going to see how you do." Okay, I mean, if this illustration here, they would have said, "Well done, good and faithful servant." Everybody got the picture? If it's all gone and you don't have $1,000 left after being given that for 40, 50 years, then it may end up a different conversation. So, wise investing principles. Let's see what there are. One, as I said, rate of return is the key. Rate of the return and time is the key. Now, the question is, loaning or owning? Now, my lovely assistant happens to be an English major. And when she was looking this over, I was putting this together, loaning or owner, she said, loaning is not a word. I go, yeah, but it doesn't rhyme. The one you want me to is lending, okay? But it is loaning or owning. And those two things, if we get in our mind, it will lead us to different application of the wealth that God has entrusted to give to us. So, what is loaning or owning? There are two places you can put your money. You can either put it in somewhere where you're owning something, or you're loaning it to somebody else. So if you look at the list on the left-hand side there, the S&P 500, that's a stock term. Standard & Poor's is 500 different companies. That's an example. That is where you own a part of that company when you get into buying stocks or equities. You become a part owner. Okay? Now, this is you become a loaner if you invest in bonds, T-bills, because you're saying the bonds might be a corporate bond, they might be a municipal bond, where you're lending to a city to build a bridge, or you're lending to a corporation to build tractors or whatever. And those are corporate bonds. You can invest in that, and they're a better rate of return, but you don't own it. You just are loaning it. And the lending rate is always, it is below, and I'm going to illustrate that in a moment. It is below the owning rate. That's the message I'm trying to get across. T-bills, that's treasury bills, where you loan to the U.S. government. and you buy some sort of government security for that. Now, here's the kicker, this bottom number down here. U.S. inflation is listed as 2.64%. I asked Siri last night, what is the U.S. inflation rate right now? 7.06, or I saw 5.69. Depends whether you talk about core inflation or the composite inflation, but it's 5.67%. But here's the killer on it. Whatever your earning is in those first three, you have to reduce it by the inflation number. You subtract it. Everybody got that? So if you're making, for example, 6.33, quote, from your bond investment, but inflation is 7.06, how much did you make? Okay, I'm leading you somewhere. Okay, it is to that top line of becoming an owner rather than a loaner. For long-term benefit, retirement planning, how do I do it? That was the question that they asked me in that class. Well, how do we do it? Well, trying to lay that out there. You go, but the stock market, it goes up, it goes down, et cetera, et cetera. Okay, well, let's deal with that. Now, as I said, some of you may be very experienced in stocks and so forth. I'm not ignorant about it. I don't have any degrees or certifications, but I've learned some things just putting this together and doing some research. And this is one thing that I had not seen laid out this way before. If you look at the stock market going up and down, on a one-day period, you get 54% of the days that are up and 46% of the days that are down. Everybody got that? So you're still on the plus side. You take it to a month, you can see the numbers going up. 62% over a year, you get 80%, 79% of the years are up. Over the 10-year period, a 94%. Over a 20-year period, you get a 100% record. Okay, so again, it is putting money in, leaving it, and letting the good businesses that you invest in pay you for for you being a part owner. You're sharing in the growth and the profit of the company, not just lending it out at 2% or something. I was doing some research on where to get a better return because there's something we have to move because of groups going out of business, whatever. But I was looking at savings rates and in the Christian context to invest, so it's helping the kingdom. And there's a Community Christian Credit Union out on the West Coast, and they are paying 0.55%. So they're paying 0.5%. Okay, and here was their ad line: 11 times the commercial rate. Now, what does that say the bank is paying? 0.05. Okay, so again, have any of you heard this phrase or a title to grab your attention? How the economy or how they are stealing the retirees' future. What it is that if you save for retirement and you put it somewhere, if you take out the inflation rate, if you're below what your earnings rate is, that's how we're being assets are being reduced. Okay, it's a declining end result if you're following what I'm saying. But stock market is one place. I was thinking this morning, real estate, could have been on a list. I don't have it illustrated here, but again, that market is up and down. And we lived in California doing the 08-09 crash, so there is no guarantee on it, etc. So, wise investing principles. Where do I put my money? You talked about stock market, but we need to talk about something else, and it's called about where to put it with tax benefits. Okay. So that's going to benefit you because there are two kinds. There's qualified for tax benefits and non-qualified for tax benefits. What am I talking about? Qualified accounts. It is an account that, according to IRS rules, has been set up to qualify for special tax treatment. What do you mean by that? Usually it is tax deferral of growth. You put some money in, and the IRS says, we're going to let, wherever you have that investing, we're going to let that grow year after year, and we're not going to tax you for it. Now, if you have it in a savings account and you get some interest on the savings account, you get taxed for it. Okay? It's my money, and it should be earning for me, but I get nicked, whatever the tax rate is. IRS does have some places that are helpful. IRS limitations apply. Usually that's with regard to, total net worth or total income in the higher numbers. Here are terms that you may or may not be familiar with. Traditional IRAs, individual retirement accounts. So it is a place for you to put money away for your retirement. Say that you're not working for a company that has a retirement plan. That's what IRAs are for, individual retirement accounts. Then there's something came out, I don't know, 10 or 12 years ago. How long ago was it, David, for the Roth? 10 or 12 or 15 years ago, something like that. Maybe in the late 90s, I'm not sure. But it's a Roth IRA, and that's a different deal. It will unpack that in a minute. Then 401ks, 403bs, 457s are all plans through your employer in one way or another. Okay, and we'll talk about the advantages of those. Pension plans, but those are just about non-existent today, where they will give you a guaranteed number. No, they say you take a guaranteed amount out, and then however it's earning when you get to your retirement, that's what you get. There are no more pension plans or defined benefit plans. Educational funds, saving up for college, that's tax favorable, and transfers to minors, accounts, etc. Thrift savings plan took me a while to figure out after hearing that, after people calling about it. But it's the government retirement. They call it a TSP. Do you have a TSP? I work for the civil government. Yeah, the U.S. government or state. Yeah. So again, that's an employer-sponsored plan. Now, which one should I be using? You have the traditional IRA, which is deductible from your income, therefore saves you that amount of tax that you pay on a yearly basis. Well, that's good, but there's one little caveat about it. Roth IRA, you don't get to deduct from your taxes, but you get this better benefit out here, which we'll talk about. And then traditional IRA, over and above those two, that would be non-deductible. So let's unpack those a little bit. Traditional IRA deductible. Tax savings now, as I said. And currently, you can contribute $6,000 per person, could be $12,000, you and your spouse. If you meet certain requirements, and against high income requirements, you may not be able to. Off the top of your gross income reduces your taxable income. If over 50 years is called the catch up, or you can do 1,000 more. So you would have $7,000 per year that you could put away. You reduce your income tax you have to pay, and then you leave that in there to grow until you reach retirement age, and the growth would not be taxed. Here's something to consider, though, and when you put it in there, the withdrawals prior to 59 and a half are taxed at ordinary income plus a 10% penalty. Okay, so if you say, hey, I want to buy a new house, I'm 55, I want to take $40,000 out, well, you're going to pay a 10% penalty, plus it's going to go onto your income for that year, and you're going to pay 15 or 20 or 30% income tax on it. So you can pay up to nearly 50% penalty for taking that money out, which is the reason you say, do not take that money out. Do not take it out. The withdrawal once after 59 and a half is taxed as ordinary income because you didn't pay income tax going in. It was exempted. So the government's going to get their income tax money one time or another. Okay, so you have to pay it when it comes out as ordinary income. However, there's a little trapdoor I'll tell you about what Ray and I use. Required mandatory distribution. If you're nearing retirement, if you're already there, RMDs. That's a household word. And it's when the government says, we're not going to let you leave your savings there. You have to take so much out every year. Why is that? They want their taxes on it. Even though I've saved it up and I may not need to have it for living expenses right now, maybe do in the future, but not right now. No, you got to take it out. And by the way, there's income tax on that along the way. RMD starts at 72, went up from 70 and a half a year or so ago. And you have to take out so much. It's about 4% of what you have in an IRA. Okay. So if you had $1,000 in there, you'd have to take out what, $400, $40? Whatever the number, $40, I think. So you have to take about 4% out every year, and some people need that for living, but you may not need it for living. Here's a Roth IRA. Contributions are not tax deductible, but your withdrawals, including initial investments and earnings, are tax-free. So with a Roth, you don't get to reduce your income tax the year you put it in, but as soon as you put it in, everything that's earned until you start taking it out is tax-free. Now, if you think about compounding and time, the earlier you are in your lifetime, the more a Roth makes sense. That you got it? Because time is what we're looking at, and whatever the return is, it'll all be tax-free. It is contributions that are made with after-tax money. So you've already paid taxes on it, and then you decide to put some into a Roth. Gives you and your spouse, again, another opportunity to put in $6,000 or $7,000. So my point is there are ways that the government encourages us on a tax-deferred basis, one way or another, to invest for our retirement so that we're not in crisis mode. When you withdraw the money from the Roth IRA, no tax if it's held for 5 years, a little caveat there, and no RMDs. You will not be asked to take so much out when you reach 72 every year, because it wasn't with pre-tax money. They've already got their tax back when you put it in. Everybody, that makes sense? Yeah, so they got it. So they go, I don't care if you take it out or not. There's some conversions you can do from traditional IRA. Say you have it in a traditional, then you can say, I want to get it in a Roth because I'm, the age of the young couple in the back. I didn't know I should have done that. It said, okay, you can, but you got to pay income tax on that because you're taking pre-tax money. But you can switch it over to a Roth IRA. Okay, and some techniques on that, you could check it out. Earlier the deposit, greater the benefit from time. With a Roth IRA, just things to consider. Withdrawals prior to 59.5, same thing, 10% penalty because it's a retirement account. Okay, it's a retirement account. The government does not want you using it at 45 and 55. The money paid in taxes is not available to invest and grow. So hear what that says. Because you paid taxes on it in that year when you put it into a Roth, that money is no longer available to compound. But there's an upside. Whatever you do earn is not going to be taxed. That's why it's a time issue, and more time is better. Traditional IRA, non-deductible, it's self-explanatory. Benefits, earnings on the IRA are tax deferred, just like the other one. Traditional IRA contributions may not be deductible from your current tax bill. And again, that comes down to calculations on your taxes and IRA and so forth, your income and so forth along the way. Benefits, non-deductible contributions will grow on a tax-deferred basis. As I mentioned, I explained that already. Okay. Traditional IRA, non-deductible, postpones payment of taxes on any earnings until they're withdrawn at a date in the future, just on the earnings. Okay. Here are the 401k, 403b, a defined contribution plan. In retirement planning, there are two kinds of plans. There's defined contribution and there's defined benefit plan. A defined contribution says I'm going to put the same amount in every month. That's a defined contribution. And then it gets invested. If you've gone through that with your employer, they'll give you a thing. How do you want this invested? Do you want it in this? Do you want it in this? Do you want it in the ABC? What's your risk and all of that? Okay. But then it says your investing is going to determine what you will get at retirement, depending where the market is at that time. A defined benefit plan, which in the church group that we served in, my wife and I, we had a defined benefit plan. And that says if you will put this in for this many years, at that period of time, you will get your pension check every month. You see the difference on that? It was a defined benefit, not a defined contribution. I mean, there was defined contribution, but that was the benefit is what is the important part of that. Employees set aside a tax-deferred retirement income. There's a trend happening right now because employees are so prone to not only spend their whole paycheck, but more than their paycheck. We've talked about that employers now are trying to encourage people to save for their retirement. Some make it automatic that they sign you up for their 401k or their 403b. You have to opt out of it. You see the difference? They say, we're going to take out, $118 every pay period or whatever it is. Well, I didn't sign up for that. No, you're in that because you need to plan for retirement. And if you need some help with that, then we're gonna work on that. Okay, thanks. So employees set aside, many of them will match. So you have an employer who says, you need to be saving at least 6%. If you put in 3, we'll put in 3. Some of you familiar with that? The employer match. Okay, we're going to see how that becomes important in a moment. There are penalties, restrictions, and tax impacts that we do not have time to talk about. But each one of these have their own rules: 401ks, 403bs, 457s, the 529 college, and so forth. It's recommended to participate, enroll to an IRA when you leave your employer. Put it in the IRA side, and you do a rollover there. You never see the money. You don't touch it. You don't get taxed on it. It keeps right on earning, and it keeps into that, tax deferred on earnings category. 403b is like a 401k, but 403bs are for educational, like colleges and schools, maybe even medical. And religious, but it's a 401k, but it's for the nonprofit sector along the way. If you see a 403b or you're having to work for one. Look at the contributions maximum here. You can contribute up to $19,500 annually versus the 6 or 7. Okay, so you want to know, what there's out there, and that's where you go to your HR department and say, okay, well, there are all the options. I'm going to give you some priority here in a moment. And the jump, if you're over 50 with what they call the catch-up contributions, is $26,000 you could put away to try to get ready for retirement if you need to do that on a catch-up basis. Now, that's the qualified accounts. There are non-qualified accounts, and we'll know them by other names, probably like a savings account, or it could be just CDs or something. They do not qualify for special tax treatment. As I said before, if we have a savings account, it bears interest, we got to pay taxes on it. There is no tax break along the way. It's that money you're saving for a specific goal or plan, to replace our car, to buy a new home, to do something, and the government says, well, go for it, but that's money that we're going to tax you on. It's funded with money left over after charitable giving, taxes are paid, funding your qualified accounts. So you're doing your retirement planning, as it were, and then your other things will come out of that. Non-qualified accounts can be rolled into a Roth IRA, but limitations apply. There's something called a backdoor Roth. You could Google that. But again, you have to pay taxes up front on it and convert from one IRA to another along the way. Here's the important slide of the investment hierarchy. Now, how many of us know rock, paper, scissors? I didn't, because they didn't have rocks or paper when I was growing up. I never played that game. But this is kind of a rock, paper, scissors. Which one wins along the way? Here's the priority you want to do your investing. The match from your employer. Why is that so important? If they put in 3 or 6, whatever the number, and you put in the same amount, what the percentage gain that you got automatically? 100%. You can't beat that. So don't let the match go by. If you're working and you have an employer that doesn't match, do not overlook that. That's 100% gain that will start to compound. Number 2, Roth IRA, as I said, and the younger you are, the more benefit, because you pay taxes up front, but then you got the earning for all of those years up to 59 and a half or 70, wherever, and you pay no taxes when they're coming out, is what the promise is today, right? Nobody knows the future totally, but that's the promise as of today. Then 401k for your employer, whatever. Then traditional IRA is the number 3 category, and then up to the maximums on the 401k and the 403b. So that's the priority when you sit down with your spouse, or you're looking at your stuff, or you're talking with the HR people. Where do I, take my payroll deduction in order that I'll be in good shape for retirement? There is an investment hierarchy, and go back to this slide here, and this will be upheld. Somebody said, what about annuities? I used to say no, 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 because here's why that was true a few years ago. That if you had an annuity, if Don Reed bought an annuity, and I had $50,000 or whatever it was, and they'd say, okay, we're going to pay you this from 70 on or whatever the number was. If I died the day after I bought an annuity, guess where my money stayed? With whoever sold it to me. Now, because that became an impediment to selling that product, I can't imagine that at all. That there are now a whole bunch of variables on it, but they are generally an insurance product. Options may provide guaranteed future income for life, or it could be a period of time. It is fixed or variable returns. It can be complex to understand, may not benefit your estate at death. Now, what's the upside for annuities is security. You know, if you're afraid you're not going to have enough month by month, and you have the asset to do it. But my counsel is read the fine print and see what the benefits are if you end up with a very short lifetime, because insurance companies, et cetera, have made a lot. Now, you will hear annuities advertised by Christian organizations, Kingdom Causes. You know, buy an annuity for, I just heard American Family Association, American Family Radio. Anybody listen for that? You know, buy an annuity. There will be some charitable results of giving. Okay, if you understand that, that's fine. Okay, but if it's just to go to the insurance company, Transamerica, to build another, tower somewhere, I would not suggest it. Life insurance is a part of, planning for the future as well. Again, the recommendation is to buy term insurance, not whole life or universal life. And again, a bigger conversation, but what you need to do is think, if I were to die, what things need to be paid off at the time of my death, or who is counting on me for income past my death? And buy life insurance for that much. Term insurance, just like you buy car insurance. If you don't have an accident, you don't collect. That's okay. You had protection during that period of time. Universal life and whole life, again, it's a savings plan with a very poor return, is a simple way of talking about that. Shadow investing, HSA is a health savings account, is a very interesting piece out there right now where you can put money away into a health savings account, and it's for your medical expenses for that year, but you don't have to spend it for your medical expenses, and it carries over. There used to be a plan, a cafeteria or something that, there was another health plan where if you didn't spend it, you forfeited it. And then people would go out at the end of the year and make all their doctor appointments for elective surgery and so forth in December and drive the medical people crazy. Okay, but this one carries over. It can become a health savings account. It's called shadow investing. What you do is not spend it for health costs during that year, but pay it out of your pocket. Leave your savings account alone. Everybody following me? And then and you get it in an earning position there, shadow investing. Now, you can approach investing three different ways. DIY, do it yourself with help, or advisor manage. I'm going to walk through these kind of succinctly. With do it yourself, you basically build a portfolio of index funds. For example, index funds are a family of some affinity. It could be tech, it could be industrials, it could be, municipality. There's something, an index of funds are a family of funds. Now, the reason you have a family is so you don't have to worry, does this stock go up or down this day? Buying a group, it averages out, okay, on your index funds. You can use a target date fund. I'm a little skeptical on that. The returns that the reports on the returns have not been encouraging using a target date fund. That means I say I'm going to need my money in 2035. And there's a product out there now you can buy where they will invest until 2035. They will put it in where they think that is the best. It's going to end up with the most out here at 2035. But I don't think they've had a sterling record on that, so investigate well on that one. Do it yourself with help. The pieces of it, not all of it, but the two probably important ones would be subscribe to an investing newsletter where you pay $150 a year, $1,000, depending, the levels of stuff that are available. And you just invest according to their recommendations. You don't have to know a lot about stocks. You don't have to understand it much. They'll say, buy this, buy that, sell this. And every month they'll send you some information of how to manage. So you are doing it yourself, but with some expertise along the way. There's something called robo-investor out there because most brokerages will not give you access to a counselor, an advisor, unless you have $100,000 to invest. Okay, so what do you do with those people? There's a robo-advisor. So you put in what assets I have, what is my risk tolerance, what is my age, what are my goals, et cetera. And they will, with the computer, send you recommendations of what to do. Everybody kind of follow me on that? It's just kind of halfway in between. But it's somebody figuring out to give you advice because you may not be particularly familiar with this field. An advisor managed investing, you have your person you talk to, and they say, okay, here's what we need to do, et cetera. But I have a little asterisk here, which says your money is still always your responsibility. That comes out of the parable for one. It was given to you to manage. And the owner is going to ask, how did you do? Don't say, well, my advisor blew it. No, you ask. You become informed, and I'll show you some cautions here in a moment. Understand the decisions, ask the right questions. Where do I go and who do I use? The most important aspect is a relationship, or we could put the word chemistry down there. Interview some people and just see who fits, who you're comfortable with, who seems to be open to your questions, somebody who will listen to what you say, not just have a speech that he's giving a sales pitch, he or she is giving as a sales pitch. Relationship. Find a person with the heart of a teacher. You want to be learning along the way, okay, of why we're doing this. Why is this better than that? Why are we moving from this stock to another stock or another category of index fund, et cetera? Use someone you trust. How do I know? Ask people. Use referrals. Hey, I've heard you talk about your financial advisor. I think by next class, I just thought about it, I think last night, we just recorded, how many of you know Mike or Becca Mulvaney? Yeah, some of you do. Yep. And they just did a video recording on how they've handled their money, et cetera, et cetera. And I'll do a little 2-minute clip. But referrals is a part of where they got where they are. Okay, and actually, part of the clip, as their financial planning guy, they're talking to him along the way. It's really a pretty good job that they did on that. But referrals, ask somebody else. And should have fiduciary duty. What that means is the guarantee of the counselor, your advisor, says, I will make decisions for your best interest. Not everybody signs on to that fiduciary duty. There may be some other ulterior motives. And people, there are a lot of court cases out there of, an investor taking my money, doing what he thought he wanted to do. And I'm not saying that personally, but it's court cases that illustrate that. And there's lawsuits out there. You did not trade in my best interest because I said I was just trying to do this, this, and this, and go into court over it. So ask, do they have fiduciary duty? Where do I go and who do I use? Avoid these things. They want to sell you something today. You got to sign tonight or it's not going to be available tomorrow. Good. I don't need it if it's a one-day deal. Do not disclose how they make their money. Oh, where's your piece in this? Well, that's too complicated. You wouldn't be able to figure it out, okay, well, that takes you off the list. Yeah, if you follow these rules. Don't tell you how much money they will make from you. There are fee-based financial counselors where they'll say $150 an hour, I'll sit down with you and answer your questions, discuss your situation. Or there's a percentage basis. Depending on the amount it'll be 1% or 2% or whatever the number is. And fourth, has no interest in teaching you. You're just not smart enough to get it. So pay me and I'll send you the reports along the way. Okay, how does it all come together? Creating a written investment plan. So this is where you or you and your spouse sit down and you say, here are our goals. We want to retire at 65 or 67 or 55 or whatever. What is your plan? We want to have our house paid off. We want to buy a different house. We want to retire and move to Jamaica. I mean, what is your plan? And then what are the costs on it? Your long-term financial goals and investment strategy that will help you make better investment decisions. It'll also give you a steady reference point during market storms, and this is important because there's a whole field of study out there now on the psychology of investing, and the inclination for most people, if the market is going down, what do people do? Sell. And if it's going up, what do? Buy. And that is the way not to end up in a good place. Okay. Now, I know some gray areas in there. I got all of that. But if you have a plan saying we're going to do this regularly, dollar cost averaging or whatever, go up, go down, it's not going to make any difference because you're on a plan. That's what this is talking about. Make a plan. If you sat down with a financial planner, what are the things we're going to talk about? Okay, what are your ages, annual income, financial goals, short and long term, current contributions to retirement accounts, monthly paycheck and whatever. And then they would say, let's run some numbers on that. And what that means is they can put that data in their computer and they go, okay, you're 48 and 54 and you want to retire by 65 and here, and it'll shoot out the numbers. So here's what you should be savings every month for retirement at your age. So you run some numbers, online calculators, then they'll say you need to, and we'll see the illustration with a couple here in a moment, but you need to be saving. The illustration we saw with a guy, he had 11%. That is not enough, okay, generally speaking. So they make some adjustments, choose appropriate investments, and here's the example from it. Mike and Mary, both 32, children ages 4 and 2, annual income 82 for him, 82 total, 72 for him, and Mary part-time at 10. They're doing pretty well. They got 120,000, way above the average for people 32 years of age. Their current monthly retirement contributions are $800. So that's what, $9,600 against $82,000 annual. So let's see, $82,000 would be $8,200 plus what, another half. So they're below what their current retirement contributions would be. 9% for him, Mary, $80 a month. They're also doing a college saving plan for a couple kids at a couple $100, young family, etc. They want to retire. Here's their plan. Want to retire by 67 with financial freedom. I gave you a definition of financial freedom previously in the class, and it was this. When your passive income from Social Security, your retirement, and savings at about 4% per year, when that meets or exceeds your living expenses, monthly, annual, whatever it is. Everybody got that? It's a financial freedom is when you don't have to work after retirement age comes along. Now, the Bible says a foolish person has empty shells. Not Don Reed said that. The Bible says that. In the house of the wise are stores of choice food and oil, but a foolish person devours all that he has. And that's, kind of what you've heard me talk about in different ways over the 5 weeks about where we are in our culture, spending 103%, 110% of our income, being in debt, not having house paid off, by the time we reach retirement and so forth along the way. We devour it all. It goes back to what Ron Blue said: get out of debt, live below your means, and do this for a long time, and you'll end up in a good position. What we do remember is to maintain a biblical balance in saving and kingdom investing. I've seen a number, and David, I don't know if you have, because he's in a Christian financial field as well, a number of articles and even a podcast out now on finish lines. Maybe it's just they're coming to my box because God's talking to me. I don't know. But it's finish lines. And National Christian Foundation had an article on the 3 different finish lines we all ought to be talking about. Well, this is kind of what's in red here. A biblical balance between savings, when you get to retirement age, our age, Ray and I's age, the issue is security. We don't know what health care is going to be needed for us going forward. So how do we prepare for that? And I'll tell you, we're way too old to buy long-term health care insurance. There are no policies that start where I am right now. But into maintaining a balance for how much do we have in order to be able to take care of ourselves until God takes us home. Everybody got that? That's what we all worry about sooner or later. Okay? And then what is beyond that? What should we do with it if there is anything left along the way? And again, hoarding, savings too much. Jesus called the man who hoarded too much a fool. This is the guy who built the barns. Okay? And he had to build some more barns because his crop was too good. And God said to him, "You fool, who will get what you have prepared for yourself?" And that's a question, actually, that all of us have to answer in one way or another. This is how it will be. This is the kicker verse here, 12:21. This is how it will be with anyone who stores up things for himself, but is not rich toward God. God never criticizes wealth. He never criticizes good ethic, business ethics, work ethics, good earning ethic, good economic ethics. He doesn't criticize even accumulation. But he said, don't forget God. Don't forget God. Don't forget God. This is how it will be, you fool, because you stored it up all for yourself, and you were not rich toward God. Again, going back to where we started, well done. I mean, which one are we going to hear? Well done, or you wicked, lazy servant. You didn't get anything. You could at least put it in and got 0.05 in the day in which we live. Okay, so we've got about 7 minutes here. Amazing. And I know it was like on a fast train going through that. But we do have some time to go back and anything you want to ask, or I didn't quite get that done, or have you thought about this? And I didn't say a thing about cryptocurrency, Steve. I refrained from doing it along the way. Okay, so I just say, wow, let me get out and get some oxygen. I understand it, get some fresh air. Or what do you want to ask? Yes.
Can I chime in on the HSA?
Yes, HSA?
Yes. So it's one of the most valuable items that we have out there for retirement.
Okay, we're talking to a pro here. HSA. Good.
Yes. So our healthcare in retirement is going to be our largest expense. Last year it went up between 14 and 20% for a lot of individuals.
Yeah.
And a lot of people think, oh, well, Social Security. Okay, it's going to be there, but Social Security does not keep up with the rate of inflation, doesn't keep up with the cost of living on an annual basis, right?
Yeah.
So it's truly kind of like a little bit of a loophole within the HSA.
Yes.
If you're able to fully fund it as a family each year, you don't use it,
Yep.
it will grow. You can hit the investment button. It will grow and grow just like our retirement plans, 401ks, 403bs. You also take those receipts that you pay throughout the years. Yes.
I didn't talk about that. Yeah.
Save them. Stick them on a cloud so that they're safe and protected. Take pictures of them because, paper disintegrates over time.
Yep.
It's also an excellent way to bridge between Social Security and retirement, or say that you want to retire early, right? You can submit all of those receipts that you've saved over time to the HSA, get that money tax-free because they were qualified expenses.
Yep.
And then you're able to bridge on the amount of time. Say that you don't want to wait till 62 and a half, you want to retire at 62.
Yeah.
You can have 6 months of money saved up, you turn those receipts in and you're covered. So it's just a great vehicle once you're able to get there, be there, if you have access to one.
Thank you, Jesse. Incredible, pieces that I didn't include in, but that is great. Yeah. By the way, Jessie is. I invited Jessie and her husband James to come because she is. What's the official title of you in fellowship?
I'm the fiduciary on the board.
She's a fiduciary representative, and so she's meeting with all of our staff because we've switched over from a 401k to a 403. I say we, I'm a volunteer, but fellowship has switched over, and Jesse's our go-between and knows this field. So thank you for filling that out. That's just perfect. Yeah. So if you heard what she said, you save those receipts and they become cash to you in the future.
Tax-free cash.
Yeah, or, and correct me if I'm wrong on this, but somewhere I read that if you have medical expenses, well, I guess it'd be the same thing. It goes against that after you quit working, quit putting in the HSA.
Yeah, and it'll cover, when you have to sign up for Medicare, you can pay all of your premiums, everything right
Yep.
out of there.
Yeah.
And it really lifts the burden.
Yeah, huge. HSA, look into it at your employer. Thank you, Jesse. Thank you. Good question. Okay? Anything else?
I have a question that may be way off the subject,
Okay.
but there's a lot of advertising for title insurance, insurance
Title insurance?
on your home. Yes. See.
Okay. No.
You have gone blank too on that.
Well, because that's a generic title. There is.
And I've talked with my people at the bank. I've talked with my insurance agent. Nobody knows anything about it.
Okay.
But there's a lot of commercials about it.
Yeah.
Okay.
Take commercials where they're saying that someone could steal your title of your
Here's
home
what you do.
months.
You go to the county, not your bank, and there is a form you fill out that will keep somebody from stealing the title. That's what I was told. And I got a
Wonderful.
card and I called Benton County, because we live in Benton County. So you call the county and ask, it's not an insurance product, it's not a bank product. It is, they will put on your record something that will not give people access that should not be there. That's my understanding. Anybody else have better information?
That's wonderful to know because I've not been able to figure.
Yes, the county. This was where,
Because most of our investment is in our home,
Yeah.
So we don't want to lose that.
Well, there's title insurance. What I didn't know where you're going, Barbara. There's title insurance when you buy a house. It makes sure that it's a clear title to it and you really can be the owner.
Yes.
That's title insurance. This is not insurance.
Theft insurance.
It's just something they check in their records. Nobody will have access to it except Donald and Rachel Reed.
Great, thank you.
The best I know. Best we have here. Good question. I love out of box questions. Cool. Okay. Now, is that all on this topic? Okay. Again, if you want to talk more about it, I'll be happy to do that. Do you all have my email address? Has that been in the material or not? Was it somewhere?
No, thanks.
I don't remember.
But Ray's,
I don't either. I don't know. I'll put it up here. If you say, hey, can we get together and have coffee and talk about da-da-da-da? damdon@gmail.com. You can get to me. Okay, next week we are doing the Will and Trust Seminar, which some of you have been waiting for, maybe with bated breath. And one, it'll be important to be here in person. Two, and this should have been live streamed today, but it's not, but we will have some people that are watching live stream. So when we get to the end of the presentation, I'll be giving some information about codes that you'll need and procedures and so forth to get into the Will Trust Seminar Onramp. Everybody with me on that? So, and we've gone through this once back in July. People found it really easy to do, really happy with the product and so forth, and I think you will be. Ray and I went through that to update ours. We had one from 1995 in California. California is a community property state. Arkansas is not, so we got that updated and taken care of and things the way we want it to be. But next week will be great. Will and Trust Seminar, how to avoid probate, how to get your papers in order, how to get it done for no out-of-pocket costs, and done in a very professional way. So, okay, we'll pray and go. Father in heaven, thank you again for this day. People that are interested in being good managers and stewards of what you've given to them, and I pray that as conversations take place in the car, around the table, or over the ensuing days, that there be adjustments made and some things that are being done in order to be better prepared when we come to retirement, or more importantly, when we stand before you and God says, how did you do with this stuff that I gave to you? So by your grace, help us understand. And I just think of the words that Jesus said about the dear lady that made a sacrifice for hers. She did what she could. And that's all you ask of any one of us. So let us be wise and do the best we can for you through your honor and glory. I pray in Christ's name. Watch over us during the week. Keep us well and look forward to being back next Sunday in Christ's name. Amen. Thanks for being here. Okay, good to see you.
Thanks for having us.
Not my wife today.